Hey friends, Iggy here, and welcome back to the Investing Iguana. Today we're diving into something really interesting. Is China experiencing its own market exceptionalism while the US markets take a breather? If you've been watching the global markets lately, you know things are shifting. So grab your favorite drink, settle in, and let's explore what's happening and how you can position your portfolio. Before we jump in, quick reminder that I've been covering stocks, finance, retirement planning, and wealth building strategies for years now. The Investing Iguana was recently ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with our content reaching over 768,000 reads and 53,000 likes. We've produced more than 700 videos with over 300,000 watch hours as of December 2024. Pretty wild journey, right? So what's going on with the markets right now? Well, the big story is that US exceptionalism seems to be taking a time out. For those who might be wondering, what exactly is market exceptionalism? It's when one country's market significantly outperforms others for an extended period. The US has been the star performer for years, but that momentum is slowing down. US exceptionalism hitting the brakes. Why is the US market losing steam? It's a perfect storm, really. We're seeing disruptive domestic policies combined with tariff uncertainties that are making the economic outlook pretty foggy. Think of it like driving through thick fog. You naturally slow down because you can't see what's ahead. This uncertainty is having real effects. Consumer sentiment is taking a hit and business confidence is weakening. Would you make big spending decisions if you weren't sure what tax policies or trade rules might change next month? Probably not. Here's something that might surprise you. China's recent DeepSeek AI breakthrough has actually put pressure on US AI stock valuations. This sent the red-hot US stock market into what we call a technical correction. That's when prices fall at least 10% from their recent high. What's my take on this? I think the US market uptrend will likely pause in the near term. We probably won't see a strong recovery until we get clear signals of a Fed put. That's when the Federal Reserve steps in with supportive policies like rate cuts to prop up markets. But here's where it gets interesting for investors looking to diversify. China's market advantage. While the US takes a breather, both the EU, especially Germany, and China have an opportunity to benefit from improved global liquidity flows. But between these two, China seems better positioned. Let me break down why. First, China may attract investors who are looking to diversify away from the crowded US AI trade. With recent breakthroughs like DeepSeek, China is showing it can compete in the AI space. Think of it like this. If everyone's at one restaurant with a 2-hour wait, the smart diners might head to the equally good restaurant next door with no line. Second, Chinese companies are showing improving fundamentals with stronger earnings per share revisions. In simple terms, their profit outlook is getting better, not worse. Third, Chinese stocks are more attractively valued right now. If US stocks are selling at premium prices, Chinese stocks might look like they're on sale in comparison. Fourth, Chinese companies generally have less exposure to the US market. This means they're somewhat insulated from US economic hiccups or policy changes. It's like having a roof that doesn't leak when it rains. Have you been watching global investment flows? There's ample room for global investors to return to Chinese markets after years of outflows. And finally, Chinese markets have historically shown lower correlation with US markets. They don't always move in the same direction at the same time. Does this mean you should dump all your US stocks and go all in on China? Absolutely not. But it does suggest that adding some exposure to Chinese markets might be a smart diversification move right now. Investment strategy, where to focus. So what's the game plan? I'm maintaining a positive view on Hong Kong stocks with a strong preference for tech stocks. These companies are positioned to benefit from the ongoing AI revolution and China's growing tech capabilities. But here's an interesting short-term opportunity. High-yield names, including Chinese banks, might catch up in the near term. Why? Because cautious sentiment is building ahead of the peak results season, and as we approach the due date for the US review of China trade issues. When uncertainty rises, investors often seek refuge in stable, high-yield investments. Now let's talk about what I'm becoming more cautious about. I'm exiting the tactical property trade. The Chinese property sector has been through a rough patch, and while there was a temporary opportunity there, I think the easy money has been made. I'm also becoming more selective on consumption stocks. Not all consumer companies are created equal in this environment. Some will thrive despite economic headwinds, while others might struggle. Have you been watching the data center sector? I've upgraded it to positive as these companies will be direct beneficiaries of rapid AI development. Think about it. All those AI models need massive computing power and somewhere to live. Data centers provide exactly that. In my top picks, I'm making one significant change, replacing CR Power with HKX Hong Kong Exchange. Why? HKX will likely be supported by better market turnover and recovery in IPO volume. As market activity picks up, the exchange itself benefits from increased transaction fees and listings. What this means for your portfolio. So, what does all this mean for you as an investor? First, it's a reminder that diversification isn't just a buzzword. It's a crucial strategy, especially when market leadership is shifting. Second, it highlights the opportunity to look beyond your home market. Many investors suffer from home country bias, overinvesting in familiar markets while missing opportunities elsewhere. Third, it suggests that the AI revolution isn't just a US story, it's global, with China playing an increasingly important role. Having exposure to both markets might give you the best of both worlds. Are you positioned to benefit from these shifts? Take some time this week to review your portfolio. Are you overly concentrated in US stocks? Do you have exposure to the themes we've discussed today? Making small adjustments now could pay dividends later. Remember, successful investing isn't about making dramatic all-or-nothing moves. It's about thoughtful adjustments based on changing conditions. Think of it like steering a boat. Small rudder adjustments keep you on course without tipping everyone overboard. I'd love to hear your thoughts on this. Are you considering adding more international exposure to your portfolio? Have you been investing in Chinese tech or Hong Kong stocks? Drop your comments below and let's get a conversation going. If you found this analysis helpful, please hit that like button and subscribe for more insights on global investing opportunities. Next week, we'll be diving into specific AI companies worth watching in both the US and China markets. So make sure you're subscribed so you don't miss it. This is Iggy from the Investing Iguana, helping you navigate the global investment landscape. Until next time, happy investing.